Critical Man Pictures presents the Forex video training series. Blue Belt course, Introduction to Chart Patterns. An astute trader would ask themselves if there is a way to detect possible movement for the day at a glance, without having to ponder over technical analysis for 20 hours. There actually is a way to help you spot potential explosions in the market before they happen, potentially making you oodles of pips. I am, of course, talking about chart patterns. What learning the chart patterns and formations will do when correctly identified will help you identify the explosive breakout before it happens. Remember, the goal of Forex traders is to spot big movements before they happen so they can ride out the wave and rake in the cash. Chart formations will greatly help us spot patterns and conditions when the market is ready to break out. It can also indicate whether the price will continue in its current direction or reverse. So we'll also be devising some nifty trade strategies for these patterns. A double top is a reversal pattern that is formed after there is an extended move up. The tops are peaks which are formed when the price hits a certain level that can't be broken. After hitting this level, the price will bounce off it slightly, but then return back to test the level again. If the price bounces off that level again, then you have a double top. In the left image, you can see the two peaks or tops were formed after a strong move up. Notice how the second top was not able to break the high of the first top. This is a strong sign that a reversal is going to occur because it's telling us that buying pressure is just about finished. Double bottoms, the right image, are formed in just the opposite direction and formed during a downtrend market. A head and shoulders pattern is also a trend reversal formation. In the left image, it is formed by a peak, shoulder, followed by a higher peak, head, and then by a lower peak, the second shoulder. A neckline is drawn, connecting the lowest points of the two troughs. The slope of the line can either be up or down. Typically, when the slope is angled down, it produces a more reliable signal. In the example, you can easily see the head and shoulders pattern. The head is the second peak and is the highest point of the pattern. The two shoulders also form peaks but do not exceed the height of the head. The inverted head and shoulders pattern on the right speaks for itself and is basically a reverse head and shoulders formation, except that it's upside down. Wedges signal a pause in the current trend. When you encounter this formation, it signals that traders are still deciding where to take the pair next. Wedges could serve as either continuation or reversal patterns. A rising wedge is formed when price consolidates between upward sloping support and resistance lines. Here, the slope of the support line is steeper than that of resistance. This indicates that higher lows are being formed faster than higher highs. This leads to a wedge-like formation, which is exactly where the chart pattern gets its name from. With prices consolidating, we know that a big flash is coming, so we can expect a breakout to either the top or the bottom. If the rising wedge forms during an uptrend, it's usually a bearish reversal pattern. On the other hand, if it forms during a downtrend, it could signal a continuation of the move. Either way, the important thing is that when you spot it, you are ready with your entry orders. Rectangles are formed when the price is bounded by parallel support and resistance levels. A rectangle exhibits a period of consolidation or indecision between buyers and sellers as they take turn throwing punches, but neither has taken over. The price will test the support and resistance level several times before eventually breaking out. From there, price could trend in the direction of the breakout, whether it's to the upside or downside. In the example, we see the pair was clearly bounded by two key price levels which are parallel to one another. We just have to wait until one of these levels break and go along for the ride. Remember, when you spot a rectangle, think outside the box. Pennants are similar to rectangles. Pennants are continuation patterns formed after strong moves. After a big upward or downward move, buyers and sellers usually pause to catch their breath before taking the pair further in the same direction. Because of this, the price usually consolidates and forms a tiny symmetrical triangle, which is called a pennant. While the price is still consolidating, more buyers and sellers usually decide to jump in on the strong move, forming the price to bust out of the pennant formation. A bearish pennant is formed during a steep, almost vertical downtrend. After that sharp drop in price, some sellers close their positions while other sellers decide to join the trend, making the price consolidate for a bit. As soon as enough sellers jump in, the price breaks below the bottom of the pennant and continues the move down. As you see, the drop resumed after price made a breakout to the bottom. Triangles are the last type of chart pattern we will discuss. A symmetrical triangle is a chart formation where the slope of the price's highs and the slope of the price's lows converge together to a point where it looks like a triangle. What's happening during this formation is the market is making lower highs and higher lows. This means that neither buyers nor sellers are pushing the price far enough to make a clear trend. This is a type of consolidation. Ascending triangle. This type of formation occurs with a resistance level and a slope of higher lows. What happens during this time is that there is a certain level of buyers cannot seem to exceed. However, they are gradually starting to push the price up, as evident by the higher lows. Descending triangles are just the opposite of ascending triangles.